If you invested $10,000 in a typical actively managed fund 20 years ago, you'd have around $49,000 today. Sounds pretty good, right? But if you put that same $10,000 into a boring index fund, you'd have $73,000. That's a $24,000 difference from doing literally nothing. And it gets worse. Over a 30-year career of investing, that gap explodes to over $300,000. Not because of some genius stock pick, not because of insider knowledge, but because most of the professionals you're paying to beat the market can't. And today I'm going to show you exactly why, with the real data. Hey, I'm Joe, and this is Joe Invests. This is the channel where we break down money topics with actual numbers, not hype, not fear, and definitely not some guy in a rented Lamborghini telling you to buy his course. Today we're settling one of the biggest debates in all of investing, index funds versus actively managed funds. And I promise you, by the end of this video, you'll know exactly where your money should go. Okay, let's start with the basics, so we're all on the same page. An index fund is a fund that just buys everything in a specific market index, like the S&P 500. It doesn't try to be clever, it just mirrors the market. If the market goes up 8%, you go up roughly 8% minus a tiny fee. An actively managed fund is different. You're paying a professional fund manager, sometimes a whole team, to pick stocks they think will beat the market. They do research, they analyze earnings reports, they make big bets, and they charge you more for it. So the question is simple. Does paying more for active management actually get you better results? Let's look at what the data says. Every single year, a research group called S&P Global publishes something called the SPIVA Scorecard. SPIVA stands for S&P indices versus active. It is the most comprehensive study comparing index performance to active fund performance, and they've been doing it for over 20 years. Here's what the 2023 report found. Over a one-year period, 60% of actively managed large-cap U.S. funds underperformed the S&P 500. Okay, 60%. That's already a majority failing in just 1 year, but stretch it to 5 years, and 80.3% of active funds underperformed. Over 10 years, 86.5% underperformed. And over 20 years, 93% of actively managed large-cap funds failed to beat the index. I want you to sit with that number for a second. 93%. That means if you picked an active fund manager 20 years ago, you had roughly a 7% chance of picking one who would actually beat the market. Those are worse odds than a coin flip. Those are worse odds than most casino games. And this isn't just a US thing. The SPIVA data covers international funds too. In Europe, over 88% of actively managed European equity funds underperformed their benchmark over 15 years. In emerging markets, similar story. Now here's where it gets really painful. Fees. The average actively managed fund charges an expense ratio of around 0.68% per year, according to Morningstar's 2023 fee study. Some charge over 1%. A few charge 1.5% or more. Meanwhile, the Vanguard S&P 500 Index Fund, the VOO, charges 0.03%. That might sound like a tiny difference, but let me show you what it actually costs. If you invest $500 a month for 30 years and earn an average return of 10%, but you're paying a 1% fee, you end up with about $770,000. That same $500 a month at the same return, but with a 0.03% fee, you end up with about $1.1 million. The fee difference alone cost you over $330,000. You didn't get better returns, you didn't get better service, you just paid someone more to give you less. Professor Burton Malkiel from Princeton, the guy who wrote A Random Walk Down Wall Street back in 1973, has been making this exact point for over 50 years. He showed that a blindfolded monkey throwing darts at a newspaper stock listing could select a portfolio that would do just as well as one carefully picked by experts. And the data has proven him right, over and over and over again. So if the data is this clear, if it's been this clear for decades, why do actively managed funds still exist? Why do people still pour trillions of dollars into them? This is where it gets really interesting because the answer isn't about money, it's about psychology. The first mechanism at play here is something behavioral economists call the skill illusion. Daniel Kahneman, Nobel Prize winner and author of Thinking Fast and Slow, studied this extensively. He looked at 25 years of data from a wealth management firm and found that the year-to-year correlation of fund manager performance was almost zero, meaning a manager who did great one year was no more likely to do great the next year than any random manager. Their success was essentially luck, but the managers themselves and their clients interpreted it as skill. Kahneman calls this the illusion of validity. We see patterns where none exist, and we attach narratives to random outcomes. The second mechanism is what researchers Brad Barber and Terence O'Dean at UC Davis identified in their famous study, Boys Will Be Boys. They analyzed over 35,000 brokerage accounts and found that the more actively people traded, the worse they performed. The most active traders underperformed the market by 6.5 percentage points per year. Why? Because every trade has a cost: commissions, spreads, taxes, and every trade is a bet that you know something the market doesn't. Most of the time, you don't. Fund managers fall into the same trap. They trade more because that's what they're paid to do. They have to justify their fees by doing something. But that something often destroys value rather than creating it. The third mechanism is survivorship bias, and this one is sneaky. When you look at mutual fund performance data, you're only seeing the funds that survived. The ones that perform terribly, they get quietly merged into other funds or shut down entirely. They disappear from the record. A study by Vanguard's research team found that over a 15-year period, roughly 46% of all U.S. equity funds were either merged or liquidated. Almost half of them just vanished. So when an active fund company says, hey, look at our great track record, they're showing you the survivors. The failures are buried. It's like a magician only showing you the tricks that worked. The fourth mechanism is what I call the narrative trap. We humans love stories, and active fund managers are incredible storytellers. They'll say things like, we see tremendous opportunity in the artificial intelligence space and have positioned our portfolio to capture that upside. That sounds so much more compelling than we bought everything and we're going to sit here. Professor Meir Statman at Santa Clara University has written extensively about this. He argues that investing isn't just about returns, it's about emotional satisfaction. People pay for active management the same way they pay for lottery tickets. They're buying the feeling of possibility, the story that someone smart is looking out for them. And the financial industry knows this. They spend billions on marketing to maintain the narrative that active management is worth the premium. But the data doesn't care about narratives. The fifth and final mechanism is misaligned incentives. Fund managers get paid based on assets under management and not performance. If a fund manager has $10 billion in the fund and charges 1%, that's $100 million in fees every year, whether the fund beats the market or not. As the legendary investor Charlie Munger once said, show me the incentives and I'll show you the outcome. The incentive is to gather assets and keep them, not to beat the index. Okay, so we've seen the data and we understand the psychology. Now let's talk about what you should actually do with this information. Step 1. If you're just starting out or you want a simple approach that beats 93% of professionals, buy a broad market index fund and contribute to it consistently. The three most popular options are Vanguard's VOO, which tracks the S&P 500, Fidelity's FXAIX, which does the same thing, or if you want the total U.S. stock market, including small and mid-cap companies, Vanguard's VTI. If you want global diversification, Vanguard's VT tracks the entire world stock market, both U.S. and international, in one single fund. Its expense ratio is 0.07%. Step 2. Automate your investments. Set up automatic contributions from your paycheck or bank account into your index fund every 2 weeks or every month. This is called dollar cost averaging, and it removes emotion from the equation entirely. Let's say you invest $400 per month into VOO starting at age 25. Assuming an average annual return of around 10%, which is roughly the S&P 500's historical average, by age 65, you'd have approximately $2.1 million. You didn't pick a single stock. You didn't watch a single earnings call. You didn't pay a fund manager to have lunch at a steakhouse on your dime. $2.1 million from $400 a month and patience. Step 3. Keep your fees below 0.2%. This is a hard rule. Any fund charging you more than that needs to have a very compelling reason, and almost none of them do. If you're in a 401k through your employer and the only options are higher fee funds, look for the index fund option. Almost every 401k plan has one now. If yours doesn't, talk to HR about it. And in the meantime, consider maxing out a Roth IRA on your own where you have complete control over fund selection. Step 4. Ignore the noise. Every single year, there will be a hot fund manager who beat the market. They'll be on CNBC. They'll be in the headlines. Everyone will say, "See, active management works. You just have to find the right person." But remember the SPIVA data. This year's winner is almost never next year's winner. A study by Dimensional Fund Advisors looked at top-performing funds over 5-year periods and found that only 23% of funds that were in the top quartile stayed in the top quartile for the next 5 years. The rest fell to average, or worse. Chasing last year's hot fund is one of the most expensive mistakes retail investors make. Step 5. Understand when active management might make sense. I want to be fair here. There are narrow situations where active management can add value. In highly illiquid or inefficient markets, like certain areas of small-cap international stocks or distressed debt, skilled managers can sometimes find genuine mispricings. Some tax loss harvesting strategies require active management. And certain hedge fund strategies that are uncorrelated to the stock market can make sense for very high net worth individuals trying to reduce volatility. But for 95% of people watching this video, a portfolio of 2 to 3 low-cost index funds is the optimal solution. Here's a simple 3-fund portfolio that would serve most people beautifully. 60% in VTI for total US stock market exposure, 30% in VXUS for total international stock market exposure, and 10% in BND for US bond exposure. Adjust the bond percentage higher as you get closer to retirement. That's it. That's the whole strategy. Step 6, rebalance once a year. Pick a date, your birthday, January 1st, whatever, and check if your allocation has drifted. If stocks had a great year and your portfolio is now 70% US stocks instead of 60, sell a little and buy more bonds or international to get back to your target. This takes about 15 minutes once per year. Warren Buffett himself, arguably the greatest active investor of all time, has said that his instructions for the money he's leaving to his wife are to put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. If the greatest stock picker in history is telling his own family to use index funds, that should tell you everything you need to know. So let's bring it all together. In Act 1, we looked at the real data. The SPIVA scorecard shows that over 20 years, 93% of active fund managers fail to beat a simple index fund, and the fees they charge for that underperformance can cost you hundreds of thousands of dollars over a lifetime. In Act 2, we explored why this keeps happening despite the evidence. It's the skill illusion that Kahneman identified. It's the overtrading that Barber and Odine documented. It's survivorship bias hiding the failures. It's the narrative trap that makes active management feel better than passive. And it's the misaligned incentive structure that rewards asset gathering over actual performance. In Act 3, we built the solution. Buy low-cost index funds, VTI, VOO, VXUS, BND. Automate your contributions. Keep fees below 0.2%. Ignore the headlines. Rebalance once a year. And let compound interest do the heavy lifting for the next 20, 30, 40 years. Here's what I want you to take away from this video more than anything else. Investing doesn't have to be complicated. The financial industry wants you to think it's complicated because complexity is how they justify their fees. But the data is overwhelmingly clear. Simplicity wins, patience wins, low costs win. You don't need to be smarter than the market. You just need to own the market and wait. That $24,000 gap I mentioned at the top of this video, that's not just a number. That's your family vacation fund. That's your kid's first semester of college. That's the difference between retiring at 62 and retiring at 67. It's real money, your money. And it belongs in your pocket, not in some fund manager's fee structure. If this video helped you see your investments differently, do me a favor and hit that subscribe button. We put out videos like this every single week here on Joe Invests, breaking down the stuff nobody else explains in plain language. And if you know someone, a friend, a parent, a coworker who's paying high fees for active funds and doesn't realize what it's costing them, send them this video. Seriously, it might be the most valuable 10 minutes of their financial life. I'm Joe, and I'll see you in the next one.